On the morning of December 19, 2001, Roberto Medina walked into his Buenos Aires bank branch carrying a withdrawal slip for $8,000. He was 53. He owned a small textile import business. The money sat in a dollar-denominated account he had opened 3 years earlier, following every financial advisor's guidance after the 1989 hyperinflation. Convert your pesos to dollars, keep them in a regulated bank, trust the deposit insurance. The convertibility law guaranteed one-to-one parity. His account statement said $47,000. He needed $8,000 to pay his fabric supplier in Miami before the December 28th shipment deadline. The branch doors were chained shut. A handwritten sign, taped to the glass, said closed by government decree. No date for reopening. No explanation. Roberto stood on the sidewalk with his withdrawal slip and watched 3 other people arrive, read the sign, and walk away in silence. That $8,000 still existed. It was denominated in US currency. It was backed by federal deposit insurance. It was protected by the convertibility law that had anchored Argentine monetary policy since 1991. And Roberto could not touch it. The December 28th deadline passed. The Miami supplier cancelled the shipment. By January, the forced pacification had begun, and the system that promised to protect Roberto extracted most of what he held within a single quarter. Roberto did everything right. The system extracted his wealth anyway. What survived that freeze and what vanished in 48 hours was not determined by currency quality or legal protection. It was determined by a single structural variable that no financial advisor mentioned in the 1990s. By the end of this video, you will know exactly which 4 asset classes remained accessible when the banks closed, and why the most sophisticated wealth preservation strategy of the decade became the fastest way to lose half your money. Roberto was not careless. He was prudent. Exactly the kind of depositor every financial advisor in 1990s Buenos Aires would have approved of. That was the vulnerability. Here is the first thing most people get wrong about Argentine bank deposits in 2001. They were not random savings accounts. They were US dollar deposits, denominated in hard currency, protected by a law that had operated for 10 years without breaking. The convertibility plan, effective April 1, 1991, established a 1-to-1 peso-dollar peg backed by central bank reserves. Domingo Cavallo designed the system. He was the architect of the monetary framework that ended the 1989 hyperinflation. Every financial advisor in Buenos Aires recommended dollar deposits at Argentine banks as the wealth preservation strategy for families who remembered what 3,000% annual inflation had done to paper pesos. The deposits were institutional. They were sophisticated. They were backed by law. 3 pieces mattered. First, the custody mechanism. Roberto's dollars sat in Banco de la Nación accounts under his name, protected by deposit insurance, accessible through institutional channels that required a functioning banking system to operate. The sophistication of the arrangement concentrated all liquidity at a single choke point, the bank itself. Second, the legal guarantee. The convertibility law promised that every peso in circulation had a dollar in reserve backing it. The promise was structural, not rhetorical. Third, the institutional recommendation. In 1991, after hyperinflation destroyed savings, putting dollars in Argentine banks was considered prudent diversification. By 2001, approximately $67 billion sat in Argentine bank accounts. December 1, 2001. Domingo Cavallo, the same man who built the convertibility plan in 1991, signed the emergency banking decree as finance minister. The decree froze every bank account in Argentina. Depositors discovered the freeze when banks failed to open Monday morning. The withdrawal limit, introduced weeks later, was 250 pesos per week. At the official 1-to-1 rate, That was $250. In practice, it was a ration. January 6, 2002. The asymmetric pacification statute followed. Every US dollar deposit was converted to pesos at 1.4 pesos per dollar, the official rate. But the free market rate had already exceeded 3 pesos per dollar within weeks. By mid-2002, street rates climbed above 4 to 1. The arithmetic is not complicated. A depositor with $10,000 in the bank received 14,000 pesos. On the street, those 14,000 pesos bought approximately $4,700. The purchasing power loss was 53%. The depositor did everything right. The law protected him. The institution held his money. And the institution became the mechanism of extraction. Here is the custody logic. Bank deposits require a functioning bank to spend. Physical dollars in a home safe require a willing counterparty. The first depends on one institution remaining open. The second depends on thousands of individuals continuing to transact. When the Corralito decree closed every bank simultaneously, centralized custody became centralized vulnerability. Decentralized custody, dollars under a mattress, titled property transferable without banks, tradable inventory, foreign-held accounts outside Argentine jurisdiction, distributed the counterparty risk across the entire informal economy. The state could close the banks with one signature. It could not close every informal transaction in the country. 4 asset classes operated outside that frozen system. Number 1 was the asset families who remembered 1989 had already accumulated. Number 1. Physical US dollars in home safes, private safety deposit boxes, and undisclosed locations. December 19, 2001, Buenos Aires. A middle-class accountant woke up to riots outside his apartment window. President de la Rua would resign by helicopter 2 days later. The banks had been closed since Friday. The accountant walked to his kitchen. He opened a cabinet behind the rice. He counted $4,200 bills in a canvas envelope. He had withdrawn them in monthly increments starting in 1999. $200 every 4 weeks. Converted salary to cash before it entered the banking system. By December 2001, when the Corralito froze the banking system, he held $4,200 that required no bank permission to spend. The mechanism is bearer instrument economics. Physical currency transfers value on delivery. No institutional intermediation. No withdrawal limit. No frozen account. The morning the peso collapsed from 1-to-1 parity toward 3-to-1 and then 4-to-1 against the dollar by mid-2002, physical dollar holders retained purchasing power. Post-Corralito ethnographic studies document physical dollar transaction networks operating continuously through 2002 and 2003, when the peso-denominated banking system remained paralyzed. Rent, vehicle purchases, emergency medical payments, all transacted in cash the banks could not touch, but physical currency concentrates theft risk at a single address. Robberies targeting dollar holders surged during 2002. Home invasions, 6 months of food, an emergency appendectomy at a private clinic, supplier credit on restaurant equipment. That is what Buenos Aires families paid for with their car titles in December 2001, and they paid without touching a frozen bank account. Number 2, vehicles and titled property, where ownership transfer required no banking infrastructure. A Toyota sedan traded for 6 months of food inventory. A Ford pickup for an emergency appendectomy at a private clinic. A Fiat for supplier credit on restaurant equipment. The notary witnessed the signature. The civil registry recorded the transfer. The transaction closed without touching a frozen bank account. The mechanism was structural. Title transfer in Argentina operates through the civil registry system, a bureaucracy independent of the banking infrastructure. A notarized deed establishes ownership. The convertibility law that created the one-to-one peso-dollar peg required banks for currency exchange, but it said nothing about property documentation. The Corralito froze deposits. It did not freeze the notary system. Physical possession of a vehicle, combined with legal documentation, created enforceable property rights that survived the banking suspension. The record shows it worked. Property transaction volume in Argentina declined only 23% during 2002, despite the complete banking freeze. 77% of transactions proceeded. Families that owned titled assets could transact. Families that held peso-denominated deposits in the frozen system could not. But the caveat matters. Property is illiquid during normal times. Pre-crisis accumulation is expensive, and when systemic collapse arrives, distressed sellers flood the market simultaneously. Buenos Aires apartment prices fell 40% between 2001 and 2002. Yes, you could transfer a title. A bag of cement does not care what the exchange rate is. Number 3. Tradable physical inventory that functioned as both productive input and store of value. Late 2001, a Buenos Aires contractor bought 50 bags of cement, not for a job, for insurance. He paid in pesos while the convertibility law still held. 1 peso, $1. He stored them in a locked warehouse. He paid a guard. December 1, 2001, the Corralito decree froze every bank account. His company's operating capital, trapped. His suppliers' accounts, trapped. But the cement sat in the warehouse, 50 bags, purchased at parity, still worth $1 purchasing power each. January 2002, the convertibility plan collapsed. The peso fell from 1 to 1 to 3 pesos per dollar within weeks, then 4. The cement bags did not care what the exchange rate was. A bag of cement builds a wall. That utility does not change when the central bank abandons a peg. He paid a subcontractor in cement. The subcontractor paid a laborer in cement. The laborer sold 2 bags to a homeowner for food. The cement became currency because it had intrinsic use independent of the monetary system's status. Construction materials, bulk fuel in drums, imported appliances still in boxes, physical inventory with divisibility. You could trade 1 bag, 50 liters, a single television. Titled property could not be divided. Foreign accounts could not be accessed, but inventory could move peer-to-peer without a bank, without a notary, without institutional permission. Some families never had this problem at all. Number 4. Assets held in Uruguayan or US accounts physically outside Argentine legal jurisdiction. Between 1999 and late 2001, an estimated $20 billion or more left Argentina through foreign banking channels. Upper-middle-class families opened accounts in Montevideo. Some flew to Miami. They moved savings quietly. $10,000 here, $50,000 there. Wire transfers to Uruguayan banks. Cash carried on weekend trips across the Rio de la Plata. By November 2001, the pattern was visible in Montevideo deposit records. Argentine surnames, dollar accounts, steady inflows. December 1 arrived. The Corralito froze every account inside Argentine banks. The withdrawal limit hit 250 pesos per week, but the decree had no enforcement authority over foreign banks outside Argentine sovereignty. A family with a Montevideo account could drive to Colonia, board the ferry, walk into Banco Republica, withdraw dollars, the same dollars they had deposited 6 months earlier. Same account, same currency, no freeze, no pacification, no haircut. The mechanism was jurisdictional arbitrage. Argentine legal instruments stopped at the border. Uruguayan banks answered to Uruguayan law. US banks in Miami answered to US regulators. The Corralito could not reach them. When Argentina abandoned the convertibility law on January 6, 2002, and specified dollar deposits at 1.4 pesos per dollar. While the free market rate hit 3 to 1, foreign-held accounts retained full purchasing power. Account holders wired funds to international counterparties. Let me return to Roberto Medina on that Buenos Aires sidewalk, December 19, 2001, holding his withdrawal slip for $8,000. Two paths diverged in the months before that morning. The path Roberto followed: convert pesos to US dollars, deposit in regulated banking institution, trust the convertibility law, rely on federal deposit insurance. The path he did not see: withdraw those dollars in monthly increments during 1999 to 2001, store physical currency outside the banking system, accept zero-interest yield in exchange for custody independence. Both strategies started with the same asset, US dollars. Only custody location determined which survived. So far, we have seen 4 asset classes that remained spendable when the Corralito froze approximately $67 billion in deposits. Here is the protocol the record documents. First, physical US dollars held in home safes rather than bank vaults. Accessible without institutional permission, functioning as transaction currency when banking stopped. Second, titled vehicles and property transferable through civil registry rather than bank intermediation. Became barter collateral overnight. Survived as exchange medium when cash froze. Third, tradable physical inventory that captured value before the crisis. Construction materials, fuel, durable goods serving as quasi-currency through utility demand. Fourth, foreign-held accounts sitting outside Argentine jurisdiction, insulated from the Corralito because deposits existed beyond domestic sovereignty. 4 asset classes, same entry ticket, physical custody or jurisdictional independence, held outside the banking system's single choke point. The mechanism reappears. Cyprus 2013, forced haircut on large deposits despite European Union membership. Greece 2015, capital controls freeze accounts despite euro denomination. Lebanon 2019, dollar deposits become inaccessible despite nominal availability, forced conversion at substantial loss. The institutional custody choke point is not an Argentine anomaly. It is a structural feature that surfaces when banking systems fail. Roberto did not lose the money because Argentina collapsed. He lost it because the law that protected the money required the bank to be open. Custody location decides what survives, not the currency, not the legal status, not the size of the deposit. His mistake was not in choosing US dollars. It was in choosing a custody arrangement that could be closed by a single signature. The Corralito is not a Latin American problem. It is what happens when ownership and access depend on the same institution remaining open. The forensic question this raises: which institution stands between you and your savings right now? If this forensic breakdown gave you a new lens on custody risk, hit subscribe. Drop a cloak in the comments if you recognize the pattern before the reveal. Now go check where your assets actually sit. Not where you think they sit, but which institution holds the key.